Good morning, everyone, and a very warm welcome to today's session, Demystifying Financial Statements for Smarter Decisions, part of our GROW webinar series. GROW is an executive program for early mid-level managers aspiring to grow into business-critical roles. It's my pleasure to introduce our speaker for today, Professor Vibha Tripathi. Vibha Tripathi is an assistant professor in the Finance, Accounting and Control area at the Amrut Modi School of Management, Ahmedabad University. She holds a PhD in accountancy from Gujarat University. She has over 20 years of academic experience and has been involved in teaching and mentoring undergraduate and postgraduate students at the university. She teaches financial analysis to executives from Pidilite, Arvind, AMD, and postmarshal in the executive program GROW at Ahmedabad University. She has received the Chairman's Award for Excellence in Teaching. Her teaching philosophy includes blending real life companies' data, case studies, and projects along with classroom teaching. She has developed case studies that intertwine the application of accounting and finance concepts for classroom use and has been published at Harvard Business School. Her cases are used by the Rennes School of Business and other foreign universities. Thank you, Professor, for joining us today. Over to you.
Thank you, Mahek, for a very warm introduction. Good morning, everyone. Welcome to the GROW program. Just to add, I am also the program chair for GROW. If I can make some sense in making you understand what exactly is financial analysis. And my focus for the webinar would be, let me put up the slide. Can you see? Mahek, if you can just confirm.
Yes.
Yeah. So my focus for the webinar would be just quickly introducing you with the financial statements, since these could be mid-level executives who might not be aware of what financial statements are. Second, we'll be discussing around tools for financial analysis. And third, we'll take some examples where, it is very necessary for you as a mid-level executive or maybe at a senior level executive to talk to your bosses actually in financial language. So we'll be including some small caselets, case studies, which will make clear, how to use this in your daily conversations also with your bosses. So quickly, largely, I feel businesses are around these processes. So that's why business is equal to sum up of all this process. What we need to understand is today the complexity of business is so deep that one connection with the other connection is very difficult for an individual sitting in a manufacturing department to see what is marketing doing, right? And that means what is important for us is to understand that how all of these different processes are connected with each other. At the end of the day, it is making sense for the business to record it somewhere, right? Because think of companies like Pidilite or like Forbes Marshall or like HUL or like TCS. They are large businesses. Even if it's a small business, for them, the challenge is that day-to-day transactions need some kind of recording. There's somebody who is doing a shipping cost. There's somebody who is making a customer call. There's some customer sitting in maybe Germany. There's a supplier who is coming from China. And these are various transactions happening, across the year. And that means financial statements are very important for two parties. One, for the internal parties who are going to make decisions based on these different business transactions. And second, for the external stakeholders who are looking at your business, that how is your business performing, right? So every transaction has a monetary value. And this monetary value could be running from thousands to lakhs to crores of rupees for companies. So it's important that you present it in some way. So what do companies do? So basically, there are three financial statements for a company. The heart of it is within the three financial statements. If you see any company, these three financial statements can tell you exactly what's going on with the company. The first one that I'll introduce is a balance sheet, a quick introduction. Remember, we are not learning accounting. We are trying to see how these statements will help you in, making business decisions there. Second, we'll go through quickly the income statement. I don't think so we'll get time to go through the cash flows, but we will stick around the first two statements mainly for the business decisions there. Largely, what is a balance sheet? Let's say we are doing a business. For a business, what do you need? the first thing that you need is money, right? And what you see on your right hand side is something called shareholders equity. So let's say you start a business with around 5 lakh rupees. Somebody will have to fund this business, right? And it could be internal, it could be external. The one who funds this business is called the owner of the company, which is nothing but the shareholder of the company. Now understand that while I'm working in a company, it may not be a very small company which just requires 1 lakh or 5 lakh. It could be a huge funding of 1 crore, 2 crores, 5 crores, which is a very big amount. Why do I require this money? Because I want to set up my business. For setting up a business, you might require a factory, a building, people, skilled employees, unskilled employees. And that means the first thing that you have to worry in a business is, where will I get these funds from? So, of course, the owner of the business for whom the business is their baby, they might initially fund the business. But when you want to grow in a business, you will have to go with external parties also. Who are these external parties? These external parties are banks, they could be financial institutions, they could be private equity funders also who are ready to fund you. And that means for me, it is important that where am I allocating the money? So, one more time, I want to invest in the assets of the company. This is where, let me put up my pen here. Yeah. I want to invest into the assets of the company. What is required is maybe the owner's money. And if the owner's money is not enough, I'll go with some external loans there, which is nothing but my liabilities for a business. While I'm talking about a big company, it's not as easy as it seems so, right? So companies, what they do is they themselves bifurcate for internal understanding. What is it that they have to immediately pay and what is it that is long term for them? So every asset and every liability is divided in two parts. One, current in simple term means that it is short term, and one is called long term, which is called non-current assets. Similarly, liabilities are also divided in two parts, current and non-current. And as you grow in your business, what happens is you will start accumulating these profits. So one is what your owners have contributed, that is the share capital. And second is, as you grow, you have profits, you retain those profits, that becomes your reserves and surplus. You can, just quickly step in and ask questions if you are not clear. So yeah, those are largely three components of any balance sheet. Believe me, it's not a magic. Finance is not a magic. The whole of finance is into this slide. A is equal to L plus E. Somebody will have to fund the business. That is your E plus L. And this money is going here in whatever form, in terms of maybe long-term investments. You have invested in market. Maybe, you have invested in PP. Once you start your business, definitely you will have something called your customers. Customers' technical language in finance is called accounts receivable. There will be somebody who will supply the material to you. They are called accounts payable. And when you will come to the program, we will go through each of these details. What is accounts payable for a company? What is marketable securities for a company? What is inventory for a company? We will go in detail. Right now, we are just trying to show you a glimpse of what does this program includes. So it is around the balance sheets of the company. Most important is that if you are running a business, if you are a part of this business, if you are a mid-level manager, the need of urgency is very important. Now, what does that mean? Do I need to pay the long-term loans right now? The answer is no. But someday you will have to pay back those loans. So you will have to plan your funding in a way, or you'll have to plan your sales collection in a way that all these long-term loans are paid back. Not to forget, when we go for a loan, there will always be an interest factor attached to it. And that means while we are budgeting for a company, we need to make sure that we have accounted for all of these things, which is the urgency part for a company and which can be prolonged for a company. You cannot say no to a bank. You will have to pay back their interest. You will have to pay back their loan someday, right? So that's why here you see, if you can see, these are the most liquid assets for the company. Now we are going in a little bit deeper side of what these assets are for the company. So is cash in the most liquid form? Obviously, the answer is yes. If you have invested in the market, which is in short term, maybe less than a year, I've invested in mutual funds, I've invested in other equities. Is that available in cash? Yes, very much, because the moment I will require cash, I can encash it in the market. Accounts receivable are nothing but your customers. Someday they are going to pay back to you because you have sold goods to them. Of course, mostly for businesses, this will be credit sales. So you'll have to figure out how will you collect the money. You'll have to set out policies for your company. That is, when will the money come back? That's known as credit policy. So say today I'm a big company like Tata, and I've sold goods to the customers. Will I ask for immediate money? The answer is no. Businesses, 99% of the businesses do not work on cash sales. It's a myth. What we study in our undergraduation programs and what actually happens in companies is very different. So everything in business happens on credit. And that means there is a time period that you'll have to count on while you are counting on for money coming in and money going out. So maybe a company has a policy of collecting money after 90 days, which means you have sold the goods to these accounts receivable, but you are not going to get the money up to 90 days. But they are still liquid assets. Why they are still liquid assets? Because if I am in need of money, I can definitely give some discounts to the customers and I can tell them, pay back the money right now. We will give you 10% discount. That's why they are termed as liquid assets. Inventory, of course, it depends on your sales cycle, how fast you are able to convert the inventory, but it's definitely not a liquid asset. Come to the least liquid. The moment you have set up a factory, the moment you have set up a building or an office, it's not for immediate sale. You are going to perform your business based on these assets. And that means they are the least liquid. Any business would not start selling their building or their factory for fulfilling the funding of the company, right? Come to the right side, you will have to pay back to the suppliers. Like I said, let's go back to the first slide, that I am a business. If I'm running a business, for me, what's most important is that the suppliers will have to give me the material to start with this business. And that means somewhere I'm also liable to pay back to these suppliers, which are nothing but my accounts payable here. Okay. And to run a business, I might have also taken a short-term loan, which is nothing but your short-term debt. In simple language, if we are non-finance people, these are nothing but bank overdrafts. A company might also have taken a long-term debt, maybe of 1 crore, 2 crores, 5 crores, 500 crores, depending upon the scale at which your business is working. So those are your long-term debts. And of course, like I said in the first slide, that this is the capital that is a contribution of the owner plus what you have retained in the business. So that is largely your balance sheet. If somebody is telling you what is a balance sheet is a snapshot of the business, which tells you exactly, I want everyone to concentrate on these three words. What are you owning as a company in terms of assets? What is it that you owe to different parties? That is your shareholders as well as the external debt holders. And what is it that is with you as a company, which is called your net worth? What is the value of your company on paper? That is the contribution of the capital plus the reserves and surplus. Next is a very interesting statement, which is called the income statement of the company. While I'm running a business, there is constantly selling of the goods and purchasing of the material plus the expenses. And I have to somewhere account for it in my business and tell the stakeholders, this is the profit for the company. Okay, so the first line of the business is very important. And I'll time and again use this word, the first line of the business. So there are two things that you have to know as professionals. You have to use these words, the top line of the business and the bottom line of the business. Bottom line of the business is called the profits of the company. That is what you earn after everything. And the top line is how are you making the business there. So it's what you are selling. Minus, of course, we talked about buying goods. So the second part will take care of all your cost of goods sold. That is your cost of material. This is very important. If you are a sales executive, if you are a marketing executive, if you are a manager, if you are a procurement manager, or if you are any level manager, it is important for you to know where does your salary lie. Your salary lies here. Now let's go deep. The more the sales, the probability of GP is very high. And that means the probability of giving you more salaries, more bonuses, more appraisals, that will lift. Which means where does your role come? Your role comes as an executive to lift up the sales of the company. I know a lot of financial people telling me that, this is not making sense for us. I'm a sales executive. I'm a marketing executive. Why do I need to know what's the income statement of the company? It's the accountants, the CAs, they will take care of the business. But believe me, when you'll come to this program, you will know your role, that you are the one. If you're a sales executive, you are the one who is actually lifting up the first line of the business. If that's not happening, somewhere the impact will come on the operating expenses of the company. Yeah. The next part, of course, the other expenses like rent, office expenses, everything sits here in the operating expense of the company. I could be a company which could have also invested outside. So every company will have to do this. Sometimes it happens that I'm not able to sell the goods. I'm not able to get immediate money from my customers. Then what will help in these times? Your investments in the market. So you saw in the balance sheet that there are long-term investments. Everything has a connection here. So these are your marketable securities here. These are your long-term investments. Now, if you have invested in the market, you will be receiving something back there. That is called the other income for the company, or that is called the non-operating income of the company. Now, why that word is used, non-operating income? It's because whatever comes from your core business, let's say my core business, I'm into FMCG company, my core business is to sell goods related to FMCG. Now, if I've invested in the market, anything that I earn outside the business becomes non-core. And that's why they are called non-operating income or non-operating expense. I was talking about the loans part. So if you have understood it correctly, if anybody can just unmute and tell me, that is paying loans a core expense or a non-core expense? Is paying loans your regular business? You can also answer me in the chat.
If it is a non-banking finance company, then paying loans is a non-core activity, non-operating activity.
Yes, we are talking right now about manufacturing companies only.
So non-core activity.
Yes, it's a non-core activity, right? And at the end of the day, you'll get something called PBT. I'm not falling into a lot of details. I just want you to know the background because, again, I'm repeating, there could be some individuals who do not know income statement at all. And people who know what's an income statement, what's a balance sheet, please bear with me for first 10-15 minutes so that we can then demystify these financial statements, because the other participants will not understand it at all. What is an income statement for a company? So coming back, I have sales minus COGS. That gives me my gross profit. What is gross profit? Gross profit tells you what you have earned from your core business there, minus your operating expenses, everything that you have to do to run the business, your salaries, rent, marketing. That gives you your operating income. Once you have got your operating income, you will be adding and deducting certain items. So when I say adding, it will be other income. That is income from these investments that you have done in the market. The second one is the expense. That is your interest expense that I could be paying back to the banks there. Once you deduct all this, you will get EBT, which is earnings before tax. Of course, you are a company. There is no company which will not have to pay taxes there. So here you'll have to take care of your taxes depending upon you fall into which bracket, 25%, 30% for Indian companies. Then you get something called your net income, which is technically called PAT, profit after taxes for the company. Okay. And once I divide this profit after tax by the number of shares of the company, you get something called a market term EPS. What is the earnings per share of the company? So if you have to look at an income statement just in a minute, what you should look at. Number one, whether your revenue is growing constantly or not. That's very important. If you are a good business, the revenue will always grow. Second, whether your GP is growing up or not. So there are businesses where sales will grow up, but GP will not grow. Why like this? Because you are not able to control the cogs of the company. So it's very important that vis-a-vis your sales, your GP also grows there. Most important, whether your operating expenses are constantly going up. If your operating expenses are constantly going up, it shows that you are an inefficient business. Why like that? Because at some point in time, you have to crack the operating efficiency of the company. If you are doing your business well, you exactly know where to cut down on the expenses. Whether you want to spend more on marketing or not, whether you want to spend more on your salaries or not, whether you require so many employees, whether AI can help you, whether you can cut down on salaries. All this can happen once you have grown at a certain level. So it's important that you keep tracking where is the money going. And last but not the least, which particular expense is taking up this entire operating expense section from you. So if you are doing a lot of marketing, just a simple math, but vis-a-vis the sales is not happening, then your marketing expenses are not making sense for you. And that means that you'll have to keep a check on it. You'll have to revise your budgets for the marketing department. Yeah, so that's your income statement, a quick income statement. It will tell you quickly four things: whether your costs are under control, revenue growing up, whether you are an efficient company or not, and whether your company is becoming profitable or not. Anybody, any doubts till here? Are we good to go ahead? If you can just say yes, no. You can unmute and just tell us. Any doubts? No, I guess no. Mehak, has anyone? I can't see the
No.
hands raised there. Yeah.
Yeah,
Okay.
yeah, no one has raised hand.
Okay, good to go. Can we run those 5 polls quickly before we go to
Yes.
financial statements analysis?
Yes, yes.
Yeah.
I hope everyone can see the poll questions and can feed in the answers. If any one of you could just confirm if you can see the.
Yes, ma'am, it's showing.
Okay, okay, thanks. Okay, I think some of you are still pending. Should I wait?
Just for 1 more minute.
Yeah, yeah.
Yeah. Or maybe half a minute.
Yeah, I think I'll end the poll now.
Yeah. Yeah.
Sharing the results.
Yeah. Okay. I think question 3 is very important, that, what's your biggest challenge that you face while you are analyzing the financial data? We'll try to demystify that today. And yeah, what's your biggest fear while you are dealing with this financial data? Misunderstanding the numbers. I think, yeah, that will happen. That will happen if you don't know finance at all, or what numbers you have to look at. So before I go ahead, can the participants quickly come on the screen? I would just like to know that how much do you know of financial statements, just quickly, so that I know how to go ahead with the flow. How deep do I have to go? If the participants can just quickly come on the screen, or if you can just let me know that you do not have finance background at all. So raise your hand if you do not have the finance background at all. So all of them have it, I assume that way. Okay. Then good to know. How many of them, Mehak, are company executives?
So Prateek has replied in the chat that no finance background.
Okay.
Yeah.
I think this Nirmit, he said that he's from HLCC,
Yeah.
third year
Yeah.
BCom. And I think
Right.
Siddharth also said the same thing.
Yeah. Yeah.
Yeah. Sanjana,
Sanjana is the staff. Maybe Tanya.
Tanya is a faculty.
Okay. Okay.
Okay. And Payal? Okay. Okay. Continue. So, if you're thinking that, it's not my job, finance people will do it, how does this matter to me? Of course, it matters to you. You will see this in next 10, 12 slides, that every number in income statement, balance sheet, or cash flow has a connection with the decisions that you are taking, even at a, mid-level. So I thought, why not start like this? I'll portray a company uh, which is facing extreme problems right now. This is the most distressed company right now. I'll not name the company as of now. You'll know what's happening with this company actually. I'll just let you know that this is the income statement of the company from the year 19 to 2023. Just to add up, this is a company that has made extreme losses in the year 2024 also. And if I were you, if I were a completely non-finance person, then these numbers are overwhelming to me and I do not understand what's happening. So what we will try to do in this program is we'll try to use simple tools to first understand what is my company going through and how I, as an individual at a mid-level or a senior level, can help the company in indirect ways. This is the competitor company. Again, a very overwhelming data. By the way, this is the number one company as per market cap. It's based in US. It's the world's largest company. And again, I do not understand if there are so many numbers. So can we crack this data just in seconds? Can we make out some meaning of this data and do some number crunching, do some financial analysis? Will Excel help us to do this? Yes, in seconds. So we'll be using quickly 3 tools there. The first one is called common size statements. Now I deliberately showed you these 2 companies. If you would have noticed, the first company has got a sale of $71,000 million in the year 19. And in the year 2023, they were having a sales of $54,000 million. While I'm coming to the second company, which I said is the world's largest company by market cap, they have a very different number, which is $11,000 million. And in 2024, there is suddenly a number $69.22 million. Now, what is happening? If I was an employee of this X company, okay, is this worrisome for me? Should I look at the numbers, what's happening, or I should just sit in a silo in a department and keep doing my work there? Okay. So there is a very easy way to crack this. Your competitor will always have a different sales. You will always have a different sales, because fundamentally you are two different companies. You could have started at two different points in time. And that's why the numbers can never be a comparative way, a straight comparative way. You will have to convert these statements into common size statements to make some sense. So the first tool is called vertical analysis or common size, where you take something as your base. Now, what is your base here? If I'm talking about the income statement, my base will be the revenue. Now, there is a logic here that, why this tool is built up. Fundamentally, when I say the top line of the business, sales drives everything in your business. If there is no sales, there will be no work, there will be no production, there will be no manufacturing, there will be no workers, there will be no salaries. So at the end of the day, you will have to sell the product to make sure that your business goes on. Now tell me, how does this look like? That's the X company. One more time, it's the company where you saw, I'll go back so that you understand that how the numbers work for you. It was year 71,000. Its profit were 21,000. Today, it is only 1689. And if I look at the first line from 71, they have dropped down to 54. But if I convert this on the basis of 100 rupee as my revenue, now this is making a lot of sense. So let us try to interpret. I just kept 1 year's data here for you to understand. What part of your sales is just going in the cost of goods sold? If I'm earning 100 rupees, 60 rupees is going in COGS, and that makes up for 40 rupees of gross margin. Now, looking at the year 2019, I was much better as a company where I used to spend only 41 rupees in COGS, and I was having roughly a gross margin near to 60. What happened in these 5 years that this company has come down to this level? Also, the last figure, even though you don't understand finance, the first and the last line will tell you a lot about the business. What's happening here in the last line? I was a company which was earning 30 rupees out of this 100 rupee. Today, I'm earning only 3 rupees. That's peanuts. And as I said, that this X company is right now incurring losses. That means as a marketing executive, as a sales executive, as a procurement executive, we need to understand macroeconomic factors will work for companies. There are external factors that could have impacted this company so high because the COGS is the answer here. My company is today here into this position due to 2 reasons. Sales is not happening, and vis-a-vis the COGS is going very high, and that's not making sense for us. Now look at our competitor company. What magic have they done in last few years? They were a company that was spending 40 rupees on their COGS. Today, they are spending only 27 rupees. And wow, look at that last line, 35 to a jump of 48. And even astonishing is compared to the last year that we were earning only 16 rupees out of 100 rupees. Today, I'm almost 3 times, I'm earning 48 rupees. And that means this company has done some magic there. That magic is not any manipulation. That magic has come out of the sales of the company. That magic has come because it has attained that economies of scale. What is economies of scale? That when you start having more production, the cost will come down. So because this company's product demand increased, their cost came down. Of course, they were able to better negotiate with the suppliers. because as your orders will increase, you'll be able to negotiate with the supply chains there. And of course, most important is your GP is rising. Now, let me give a face to this company. This company is Intel Corp, which is the world's largest, or which was, let me correct it, which was the world's largest semiconductor chip company. It was Foundry System. It's US company that is, and US used to take pride that, we are the largest semiconductor chip makers. And then, of course, Taiwan is one of the best semiconductor chip makers. And against that, NVIDIA. Now, nobody knew NVIDIA, as a company before 10 years. There was no news about it. Suddenly, in the last 5-7 years, this company has, done some innovation in the product. And they have done a lot of sales, a lot of marketing. They've reached out to customers. So again, your role as a mid-level executive or a sales executive is very important to make sure that, you market your product in the correct way. And that will come only when your product has got that quality. So finance is also about non-finance thing. A lot of it is affected because of the non-financial factors. By the way, the latest news is that NVIDIA is going to invest into Intel. For your information, US government has announced that they will invest 10% into Intel. Now, this news is making some sense for us as an employees, because if I were the company, just look at this green line, their profits are vanishing. I mean, blue is revenue. This is my operating income. This is here, the yellow part. And then I'm coming here to the green part. I was company which is making profit, but today my profits have vanished. Wow, look at NVIDIA. They started only here and they are here today. So numbers tell us a lot about a company. And let us now compare individually. Mehak, are you able to see the screen, right?
Yes.
Yeah. So let us just look at this company. What are they doing? So basically, they are only spending 43 rupees of their sales as costs. Understand that if you are a purchaser, if you are in the purchase department, your role is to negotiate with the suppliers. The more you negotiate, the more economies of scale you attain, you can lift up the GP of the company. Another striking point is they are spending 27 rupees. We are spending 29 rupees. They are doing 9 rupee of marketing sales. We are doing 10 rupee. And at the end of the day, they are at 41 rupees of operating expense. We are at 39. Now, almost, if I look at this part, we are quite parallel. But operating income have just plunged down to 0.17. Reason, we did not make sense in the top line. That is, we did not sell enough. And second, we did not control the costs of the company. Are we good to go? And last line, of course, as I said, that this is a problem because if you will not have operating income, imagine a company is just having 0.17 paisa against 100 rupee of income. Now, what will I pay to the government and what will I actually give to my shareholders? So what has helped Intel is someday they would have done some investments. We were talking about those marketable securities. So if you can see, this 2.46 rupees was coming out of those marketable securities. And that has helped the company at least to remain positive here with 1.41. Okay. Otherwise, they would have gone into losses. Yeah. So problem. But if I were you, I would have quickly converted the company's data into common size and just try to see, what's happening to this company. You can do all of these things once you demystify, your financial statements into common size. You can spot areas where your resources should actually go. If marketing is not making sense, cut down on that. R&D, these companies cannot cut down on their R&D expenses because they are semiconductor chip companies. So they will have to spend on R&D. So where will the cut come? The cut will come on the employee's salary. That's where you are impacted. You say that, if I don't do sales, is it okay? It's not okay because the company is suffering with the top line. And eventually Intel announced that they will lay off 25,000 employees. right? So our role matters at mid-level managers as well as senior level managers. Let's go ahead. The second one, quickly, you will see on all stock exchange websites, you will see within your company, while your internal discussions are going on, your boss will always tell you that, our growth is reducing, our sales growth is reducing, our operating expenses are reducing. So quickly, the second tool is called horizontal analysis. In horizontal analysis, what you do is you look from right to left or left to right, and then you try to see what's the trend of the company. So it's basically trend analysis. It's a very simple math. What you do is you do current year's value minus last year's value divided by last year multiplied by 100. But when you do this, there is a magic that's happening that kind of gives me a vision what's happening to my company. So I've just taken a very simple example. Last year, my company was having a 100 rupee sale. This time it's 145. How much increase in revenue is happening in a single year? 45%. But vis-a-vis that, the COGS is also increasing, which means, again, going back to that point, if your sales is increasing, it will not make sense unless and until your COGS is reducing. So my COGS is increasing by 50%. And of course, GP will lift up a little bit because you have done higher sales there. What is even more worrisome is that your selling, general and administrative expenses have again lifted up by 60%. R&D expenses have gone up by 50%. Your EBIT has gone up by 20%. And of course, my PAT has gone up by 25%. This gives me a quick glimpse of what is happening to each of the element. Now you have to ask, what is the difference between the first tool and the second tool? The first tool gives you an idea of allocation. Whatever you are earning as 100 rupees, what are you allocating to each of the resources in your income statement? In horizontal analysis, you will try to gauge the performance of the company. That is, compared to last year, where are you standing in the current year in terms of profit or in terms of sales there? So quickly, these are the 5-7 things that you can do. I guess they're quite self-explanatory. If your profit keeps on increasing, there will be some strategic planning that you can do. You can plan for acquisitions, expansions. You can invest this money, in market. So your last line will make up a lot for the decisions for outsiders as well as for insiders. And of course, you can present in a very clear way to even though you are a mid-level manager, you can present this data to your boss that, see, we have made sense. If we are spending on marketing, it's also vis-a-vis our sales is also increasing. So that's important that you keep tracking. And what ratio is designed for this? It's called customer acquisition cost. Okay, so when you will come to the program, we'll go in detail for each of these elements. Right now, I'm just giving you a glimpse, what you will study in this program. Let's go ahead. Okay, I'll skip that part. I've taken some examples where you can actually start speaking in terms of financial language. When you talk to your boss, how do you need to present the data? How do you need to present your request? So first one, I have taken a very simple example. You are going to your boss and saying that we need 2 more people to answer our customer phone calls. Now, boss only looks at this as a problem that we are going to give salary to 2 more people. But you have to use some number crunching here. You have to do some number crunching. You have to see what's happening. So just quick, 5 lakh was your revenue. Your COGS was 3 lakh. Your GP was 2 lakh rupees. If I can use my red pen. And all this summing up, 80 plus 50 plus 40. So 2 lakh minus all these expenses, we were making a profit of 30,000. Now, what we are proposing to our boss is, what is a customer refund? That there are a lot of customers who are returning back their goods to us. And that's why, we have to refund them some money or we have to give them the credits back. If you can avoid this by hiring two people who will be actually able to make them understand what's wrong with the product, they'll be able to take their queries, they'll be able to handle the sales of the company, or maybe they'll be able to replace the goods for you. If that is happening, only this part will lift up. Okay, so I assume that, let's say this amount is 8,000. For keeping these two people, you just need to spend 8,000 rupees more. So your salaries will lift up from 80 to 88, but these returns will go away. And that means now you are talking more in terms of financial language. I want you to read this. You have to pitch to your boss like this. We are losing 50,000 every month in terms of getting refunds because there is nobody to talk to these customers. But if we hire two people with 8,000, per month there, then we'll be saving 42,000 rupees there. And so that's a very simple example. Let's go to the second one. Now we will use these common size and buy on buy what you learned. Let's say you are in the marketing department. You're going to your boss and saying that, see, my marketing budget is too small compared to the competitors. Your bosses do not understand this language. What is small? The definition of small could be different for you, could be different for me. And you have to talk in numbers. When you will be able to talk in numbers, when you understand what is it that your company is spending in terms of marketing, in terms of selling expenses, vis-a-vis the sales that is happening. So which tool will you use it? I want everyone to concentrate here. If your company's annual revenue is, let's say, 60 lakh rupees and your marketing spend is 1,80,000, you are spending 3% on the sales of the company. But here, if my marketing spend is 6%, I'm spending 360 as a competitor. Again, the growth of your company is only 2%, but the other company is 8%. So which tool did I use? So I used two tools. Here, I did a common size. I quickly converted the marketing spend as a percentage of revenue. And here, I talked about the year-on-year growth. Now, if I can pitch to a boss like this, that, our marketing spend is only 3% compared to the competitors, while they are growing at 8% and we are only growing at 2%. You better give us some resources so that, we can make some sense in terms of matching the marketing expenses to the sales of the company. So that's a second example. Hope that's making sense for you. Participants, if you can just say yes or no, are you able to relate? Okay, you can unmute and just tell us.
Yes.
Yeah. Okay, thank you. Let's go ahead. This is the most common problem, I think, where executives fail to understand. If you are completely from a non-finance background, this will always be a problem for you, that we are profitable, but we are running out of cash. This is the most common line that you will, hear from your department boss there. You could be in a very small department, even they could be saying this, that we are running out of cash. And you would always be wondering that, but we are a profitable company. How can we run out of cash there? Understand that profit and cash is not the same thing. So why they are not the same thing? Let's say that I'm a company, again, coming back to the same logic. I have a 5 lakh sales minus expense. All my expenses are 4 lakh. I'm having a 1 lakh profit. But these 5 lakh sales, I told you in the very first two slides that companies do not make cash sales. You have not made cash sales, right? So what you have made is credit sales. And what they are saying is, out of 5 lakh, only 3 lakh what customers have given back the money to you. 200 you have yet not collected. If you have yet not collected, what does that mean? That brings a pressure on the cash of the company. But expenses will still go on. You will still have to spend on salaries. You will still have to, spend on the other expenses of the company, marketing, admin, rent, electricity expense, etc., etc. So from 3 lakh, I have to spend 4 lakh, and I'm actually running out of cash of 1 lakh. So now you cannot demand in such situation to your boss that let's buy a 5K new software, because your boss is straight away going to reject it. When they know when to put up for the request at the right time. If you know the numbers, and that means what you have to do being a sales or a marketing executive is you'll have to say that let's focus on collecting the money faster instead of spending. So this 200K, you have to make sure that it comes on the right time because it will put pressure on the debt part of the company. Now imagine you have 3 lakh rupees and you have to still pay 4 lakh. So you are running out of cash of 1 lakh. What do? You will go to the bank and you'll go for a short-term debt there. And that will put a pressure on the interest expenses of the company. So, so it's very difficult that your boss is going to approve your offers if, approve your demands if you are falling out of cash there. So now you understand the difference between profit and cash flows of the company. Let's go ahead. Yeah, this is very important. Time and again, all sales team, marketing team, they are going to get this problem of that increase the sales. We are under extreme pressure and we need 20% more sales. You would be thinking that, we have looked at the last quarter, everything was good. Why there is a sudden panic? Why your boss is pressurizing you for sales? Your immediate answer could be profits. It's not like that. Every time your boss is pressurizing you for sales, it's not only for profit. It could be some other situations. And what could be this situation? You'll have to understand again by applying some tools to your income statement. Is this available? Yes, departmental statements are always there. You'll get some data. What is your quarterly sales? What is your raw material cost there? So imagine you are at flat sales only. So you are not working higher for the sales target. Last quarter also it was 10 lakh and this quarter also it was 10 lakh. But the raw material cost, what's happening currently. There are a lot of tariffs that Trump has put on a lot of products there. So if your raw material cost is going to go high, there is going to be a problem in the budget of the company. So in fact, if I apply Y on Y, it has lifted up by 25% there. And if I look at the other costs, they have also increased by 20,000. So that again puts up a pressure on the company where I had only profit of 3 lakh rupees last quarter. Currently, my profits have reduced to 180 in spite of having the same sales figure. And that means it is important for you to keep tracking what's happening within your business. So a simple math that you have to apply is how much sales you actually need to reach back to the profit of the last quarter. So I worked out some math here, if you can see. To maintain a 300K profit, divide it by 18%. That's where your profit has dropped down. So you need 1.67 million sales. If you had 10 lakh worth sales, but you need 1.67, which means you have to do 67% more sales in the current quarter. That brings a lot of pressure on the boss as well as on the department. So what you have to strategically do here? So, you will have to negotiate with your suppliers because your prices are rising really, really high. And only when you will negotiate with the suppliers, your cost can, come down somewhere. Okay. Mahek, do we have more time or we stop here?
I think maybe in 5 minutes we can wind up.
Yeah. Okay. That's the last thing that any business needs to understand. We will be doing again in detail when you come to the program that, what will be a cash crunch for a company. Every time there is a payment, there is a collection also. Remember, these two things are always there for a company. Payables, they are your suppliers, and receivables, they are your customers. And in between is, your inventory, which is maybe sitting in huge piles in your factory there. You will manage these three factors to make sure that there is no working capital crunch for your company. What is working capital? In simple terms, it's a short-term capital that you require to run your business. So basically your current assets minus your current liabilities. So quickly, this is a company which says that we have 5 lakh worth inventory, but our inventory cycle is 60 days. What does this mean? You are not able to sell your inventory for 60 days. Okay. Against this, you have made a sales of 4 lakh, but these customers, you have given them a time period of 48 days. Now, imagine 60 days your inventory is sitting in factory, 48 days your customers are not paying up. But the problem with this company is that they owe to their suppliers within next 30 days only, which means you are actually having a cash of only 50,000. How? Your customers owe you 4 lakh, but you have not received it, right? So if your cash available is 50,000, that's too low to pay back to the customers. Now, what you should do in such situation, the only way to go ahead is you'll have to calculate your cash conversion cycle. So right now, how much money is tied up? 5 lakh in inventory, 4 lakh with the customers, total 900K is tied up in both these factors. This is called the operating cycle of the company. And you have to pay back to the suppliers at 200K. Okay. So 108 days. My God, that's too high an operating cycle. And you are saying we will pay back to in 30 days to the suppliers. Now, what do top companies do? You take example of NVIDIA, or you take example of companies like HUL, or take examples of TCS. They are the companies who negotiate with their suppliers. And that means your solution has to be speed up the collections. Always make sure that your collections come on time. Second, you reduce your inventory. That means you will have to do lot of good sales there. And third one, like I said, you have to negotiate with the supplier. If you can crack this, imagine if this operating cycle goes down, your company will have lot of cash on hand. And that will reduce the pressure on the short-term debts of the company. Because अभी तो आपकी कंपनी के पास सिर्फ 50,000 rupees है to pay back to the suppliers of 2 lakh rupees. And that means 150 company will have to borrow from the market. Okay, but if you can crack this, you will not have to borrow it, and you can pay it from your own collection from the customers there. Yeah. So, and lot of this, the third tool that we will be using is financial ratio analysis. We don't have time, but yeah, there are a lot of things that we can do within this 1 hour webinar. I just showed you glimpse of, what you can do even as a non-finance person. If you understand your company, you can understand your boss request, you can understand what your department is going through, and you can bring up feasible solutions for your department. That also kind of, make you notice compared to your other peer members, that you understand it better, what's going on with your company. So yeah, I'll stop the share if anybody has any questions there. No.
If anyone has questions, maybe you can put in the chat or unmute and just ask.
Yeah. Okay. So,
Okay, if not, then,
yeah. Mehak, if you can stay back. Yeah.
Yeah. Okay, sure.
Yeah. And
I just
Nikita, Nirmit, Sanjana, Siddharth, if you have any questions, please feel free to ask. No? Okay, then you'll have to leave the Zoom room.
Yeah, I'll just close. So thank you everyone for joining in today. On behalf of Ahmedabad University and everyone present, I'd like to thank Professor Tripathi for sharing her insights and experiences with us. We deeply appreciate your time and contribution. I would also like to thank all the attendees for being part of this session. Thank you everyone and have a good day ahead.
Yeah, if they can. Sorry, Nirmit, you have a question. What is foreign?
Yeah, I think he has a question. Foreign remittances?
In what sense are you asking this question? Foreign remittances? If you can just tell me.
And how he's also mentioned how the statements of Forex is analyzed. How the statements are analyzed.
For whom?
How the statements are analyzed, foreign remittances.
Yeah, sorry, I did not get your question.
Nirmit, do you want to
If you
perhaps
can
unmute and ask?
Yeah, if you can just unmute and tell us what foreign remittances. Feel free to ask, but I'm not able to understand your question. Do you mean to say if you have how the statements of forex amount received is analyzed? Okay, this you can track through other comprehensive income of the company. Any kind of foreign exchange loss or profits that you have made, it will be categorized under the OCI of the company. So there is a special statement called other comprehensive income of the company, and they take care of all such transactions where you have foreign exchange losses, where you have foreign exchange gains there. What happens in case of import tariffs, that depends, on what transactions you have done. So again, there is a special, as I said, that OCI is a special standard applies to other comprehensive income of the company. And they just give you the summed up figure, the net figure. That is what tariffs have impacted the foreign exchange. Whatever it is, you will never come to know how the company has come down to that figure. The company will only tell you that this much is the foreign exchange gain or loss. Yeah, and they will give you the reason that because of the tariffs, this is the loss or profit for the company. But they will never give you the number that they have worked out. That's because financial instrument 109 applies here. And it is only that the CAs can work out on these figures, and they just tell you that this is the foreign exchange loss of the company. So did I answer your question? Yeah. Okay. Then, Nikita, you have any question? Okay. Okay, then thank you.
Okay,
Maybe, okay,
thank
I'll
you.
call you, Mahek. I think we can close
Yeah.
this.
Yeah.